Yo, what's good? What's good? Appreciate you tapping in with me today. Without further ado, let's go ahead and get into it. So first thing I want to do is let's get an overview of the agenda, just real quick. All right. So this is part of an ongoing series that I am actually developing, teaching new traders and seasoned traders, or refreshing seasoned traders on basic trading concepts. Um, and trying to give a high level overview of each one of those concepts. So, the first one that I'd like to go ahead and cover goes over candle structure and involves an introduction to support and resistance concepts. So, this might be a little bit more lengthy of a video than what I want, but it's definitely necessary. So, let's get right into it. What we're going to cover is basic candle types and structure, and at the same time, we'll also cover trading time frames. Um, Horizontal support levels. Then we'll get into trend line support and resistance. Um, I should say, and resistance levels. All right. So then we'll talk about order block identification, and then finally we'll leave off with the concept of the break and the retest. And this is a building block for price action. So yeah, without further ado, let's go ahead and jump right into it, guys. So let me stop sharing this and switch my screen over real quick. All right. So if you can see my screen, I am looking at US 30 and I'm on tradingview.com. TradingView, for anybody that's new to trading, is something that you'll definitely want to get acclimated with. So go to TradingView right after this video or even during this video, go right to tradingview.com. Make sure that you sign up. And once you sign up, you should have, there's a free version and then there's a version that you can actually pay a subscription, and that's just to be able to add indicators to your chart and be able to save your charts and view it without the ads and stuff that come up every now and then. But for now, if you're just getting started, the free version is fine. It took me a long time to pay for this for the subscription, but it's actually very worth it. Um, but for the purposes of what we're doing today, the free version is all good. So, and again, I'm looking at the I'm looking at the US. I'm looking at US 30, otherwise known as the Dow Jones. Otherwise known as Dow Jones. And when we talk about, so before we talk about the chart or the candles, what we want to get into first is daily time frame, or sorry, not daily, time frames, trading time frames. So what I am actually looking at is the daily time frame, and you'll notice that these are a bunch of, they look like a bunch of candlesticks, right? So you've got different types of charts. You don't have to look at candlesticks. Really, this is the line chart. I mean, you've got different types of charts, right? Um, you got the area, but the most useful way to look at the chart would be in what you call candles. And these candles, each one of them represents a period of time. Um, so we're looking at the daily time frame, and this means that every candle represents one day. So now that we've broken down time frames, and I'm going to go ahead and go through the different time frames just real quick. So you've got the 12-hour. These candles represent 12 hours of time apiece, and then you've got, I mean, all the way down to the 1 minute time frame. And you can see on your left how long we have until the candle closes, right? So in this case, you have 30 seconds until the minute closes, and then we have 16 hours and 2 minutes until this day closes, right? So that's really important to understand. That concept is that each one of these candles represents a period of time. Why is it important? Um, the higher the time frame that you look at, right? You got to remember that you are looking at data over a period of time. So common sense would say that the higher the time frame, the more data that you're looking at, right? And if you're looking at a larger portion of data, then that is going to tell you a lot more about what's going on in the market at the moment. So in this case, we're looking at the monthly time frame for US 30, and every candle represents a month of time. So when I get into candle types and candle structure, all of this will start to weigh in a lot heavier. So let's go ahead and get into different types of candles. And before I do that, I want to show you guys just real quick. Let's see. Every time I want to share something different, I gotta stop sharing it and then reshare. So just hang in there. All right. All right. Okay. So when we're looking at different types of candles, I just want to give like a high level overview of different types of candles real quick. I can't cover uh, all of these, but I can cover the ones that I feel like are most common. So right from here, I mean, we can see that we've got, like say, a bearish engulfing. We've got rising three methods, falling three methods, inverse hammer. You've got the morning star. You got your doji, and then you got your hammer. These pretty much cover the ones that I feel like are the most important. Um, there's a lot of good articles online that talk about exactly what I'm going to talk about today, which is the body, the wick, the color that determines what kind of candle you're looking at. Um, I'm actually going to use this article now, though, if you don't mind. So let's get into some common bullish candlestick patterns. And when they say bullish, this means that price was in an uptrend at that time. So if a daily candle is bullish, that means it closed bullish and price went up during that day. If it was bearish, price went down during that day. That's what that means. So looks like the first one that they want to cover is the hammer. And the hammer, as you can see, while we're looking at this, we're gonna actually go. I'm just gonna use this as an example or a template. We're gonna go ahead and talk about the structure of a candle in general, right? So if you look here, we have a body, right, which is this solid piece, and then we have what you call a wick. And you can have a wick on one side of the candle, like you do here, or you can have them on both sides of the candle. And wicks can come in all different types of sizes, right? And these wicks tell a story. So, in fact, the whole entire candle tells a story, right? So, what this story is with this particular candle is price opened right here. Price always opens for a bullish candle at the bottom of the body, okay? And price closed here at the top, okay? And what the wick represents is where price was at a period of time in the candle, right? It did not close there, but it was there at a period of time in the candle. So in this case, price got this low, okay, during this candle. And before that candle closed, price closed all the way back up here. So what this tells me, considering the trend that came in before this candle, is that price continued with that trend for some time, but at the end of the candle, or maybe in the middle of the candle, somewhere in that candle, price was rejected and the buyers started stepping in and pushing price up. And eventually that candle finished green. Okay. So what this implies, and what this article is implying, and is completely correct, is that price is very likely to push up after this candle, and that's exactly what it did. Okay, so that's what you would call a hammer, and a hammer is a or inverse hammer, and a hammer is a reversal candle. Okay, so you have reversal candles and you have continuation candles or statement candles. So that's a type of reversal candle. So that's a pretty common one. But looking at this one candle, we're able to cover the structure of a candle in general, and then we're able to kind of cover what what type of meaning these some of these candles have, right? So this is a reversal candle. Okay. Um, or yeah, that's a hammer. My bad. I call it an inverse hammer. This is the inverse hammer right here. The inverse hammer is upside down. So the inverse hammer, okay, kind of represents the same thing. So in this case, again, we want to look at the close, the open, the high, and the low. Right. So looks like we have price opening at the bottom of the body. It closes at the top, and we can see that there was a rejection towards the end, but it still closed green in the middle of a downtrend. Right, so price was downtrending, we closed green, and we got the reversal. Okay, so pretty much the same concept. In my opinion, I feel like this is a much stronger reversal pattern than this one here. But that's just me though. It still implies the same thing. Either one of these two candles in the middle of a downtrend represents that price is about to try to come up. Okay. And we'll get into different types of confluence that help us confirm things like this. But for now, this is just the plain Jane basics. Um, all right. Now we're going to talk about one of my favorite candles, and this is what you would call a bullish engulfing. So a bullish engulfing is a statement candle, and it normally either marks a reversal or uh, the start of a trend. And that's the same thing, really. But with a bullish engulfing, how a bullish engulfing is structured, the reason why it's called an engulfing is because it takes up the entire body of the candle before it. Okay, so the entire body of the candle is swallowed up by this candle here. So we opened here, we closed here, got as high as that wick, got as low as that wick. But the point is that price, the body of this candle overlaps the preceding candle in the middle of a downtrend. So very often in the middle of a downtrend, when you see a bullish engulfing candle form after a strong downtrend, you are very likely to see a pushback up to the top where that downtrend started. Very, very likely, at least to 50% of that downtrend. So again, you want to pay very close attention to bullish engulfing candles. Let me see if they talk about bearish before we talk about the other ones real quick. Okay. Yeah, so I'm just gonna go ahead and skip real fast. So while we're talking about bullish engulfings, you want to see bearish engulfing candles. So bearish engulfing candle will do the opposite. It will overlap the body of the candle before it. As long as that trend was bullish, and a bearish engulfing will overlap the previous bullish candle before it. So it'll mark the start of a complete downtrend, and that's what happened. Okay, so let's get back up to here. All right, piercing line. I really wouldn't say that I use this one too much. Says a piercing line is also a two-stick pattern made up of a long red candle followed by a green candle. There's usually a significant gap down between the first candlestick's closing price and the candlestick's opening. It indicates a strong buying pressure as the price is pushed up to or beyond the mid price. Okay. So, one thing that I want to say about this one, okay, the reason why this one's important is because that 50% level on a candle, and we'll talk more about this when I get into Fibonacci, is very, very important. So, uh, when we say 50%, I literally mean 50% of this candle. So one concept that I've learned and that I've actually seen applied is that when you have a say a bearish candle and that next bullish candle actually goes through the 50% line, we are very likely to overtake this candle or at least to test the top of that candle. When price breaks over the 50% line, we are very likely to break over the top or test the top. On the inverse, vice versa, when price comes and retests or respects the 50% line, it does not push through, but instead it rejects the 50% level, we are very likely to fall back to the bottom and complete another candle down. Okay. So just remember, I think the thing that I want you to take away from this one is that the 50% level on candles is very important. So when you see a bearish engulfing candle or a bullish engulfing candle, if the next candle after that comes up past the uh the 50% level on that candle, we're very likely to continue upward. So there we go. Morning Star. This is another one that's kind of, I mean, it looks almost like a, well, yeah, I really would call that a doji right there. So some of these terms are a little bit different. So it says the Morning Star candlestick pattern is considered a sign of hope in a bleak market downtrend. It is a three stick pattern, one short bodied candle between a long red and a long green. Traditionally, the star will have no overlap with the longer bodies as the market gaps both on open and close. It signals that the selling pressure of the first day is subsiding and a bull market is on the horizon. So another reversal pattern. So what they're talking about is not only this candle, but it's this entire bottom. So again, these candlesticks, they tell a pattern. And what I see is that price was coming down for quite some time. We get this bullish candle, so that's sign number one. The next candle afterward uh, tells us that this signal right here was a failed reversal. So not every reversal is going to complete, but the next candle after that tells me that the downtrend was a lot weaker in this section than it was right here. So the downtrend was very strong here, but the Bears were not able to complete a second consecutive bar that was just as strong. In fact, I would call that a doji. So a doji candle is where you have wicks almost of equivalent length on both sides, and this represents a common reversal pattern. It means that there really wasn't a decision. There was a really strong downtrend here in this candle, but the next candle afterward, there was almost no movement, right? So it almost means that this trend is about exhausted or over. And that's exactly what gets confirmed in the next candle. So in the next candle, price opens here, nearly at the start of this candle right here, and it continues up and it retests the top, almost the top of this pattern. On the next candle afterward, the bears try to bring price back down, but I would say that this reversal pattern would be failed if we broke below the low of that candle. Okay. If we broke below the low of this candle, this pattern here, then we would be continuing a downtrend. But since they were not able to complete that type of movement, then we are still open to a direction in the uptrend. And if you look here, this goes back to the 50% concept that I was talking about. It looks like it's nearly 50% of that body. Okay, so we came down and we respected 50% of that body, and then we continued up. So that's in a nutshell what this diagram is telling us, and they call it a morning star. All right. So you got three white soldiers. This is one that I use. I wouldn't say I use it a whole lot again, but my eyes are so trained at this point that I don't really call it a three white soldiers. I just call this right here a simple high and low, a simple higher high pattern, or a higher low pattern. So if we made a low, three candles follow to tell me that this downtrend is coming to an end, and we made a high, and then we made a low here, and then we continued that high. So this this time frame may be a higher time frame that we're looking at, but when we talk about lower time frames, if say this was the hourly or maybe the daily, if we zoom down on the lower time frames, we're going to see a derivative of this type of pattern. And that derivative is going to show us a lot more detail, and it's going to look like a high, it's going to look like a low, a high, a higher low, and then another high, right, to follow. That's basically what that means. When you see these three candles come up and almost overtake, if you look, it overtook 50% of that downtrend right there. It tells us that this downtrend here is most likely, more than likely, canceled out, and it's time to continue the uptrend to start a new trend. All right, hanging man. It says the hanging man is the bearish equivalent of a hammer. It's the same shape but forms at the end of an uptrend. So yeah, that's exactly what it is. So as you see, we have the uptrend here. We have a bearish hammer, or a bearish hammer. The price opened here at the top, closed at the bottom, and it looks like it got as low as here. Price was pushed back up, but we were unable. This is significant because we were unable to close higher than the open in a strong uptrend. So it indicates that we are very likely to come down and retest a key level below us in the uptrend. I wouldn't say this is the strongest reversal pattern. In my opinion, it really represents a correction, is what it does. So it's not gonna it's likely to not continue down as a complete reversal. Instead, I would say that it's likely to just retest a key level, and we're almost knocking on the door of supports and resistances when I say that. So just hang in there. Um, this is a very strong reversal pattern. This is a much stronger reversal pattern. So this is one that I use a whole lot. Price was coming up. It looks like we opened right here, or sorry, we opened here at the top of the body. We closed at the bottom, but look at this rejection here. So this wick, we got as high as this level. So it looks like the bulls tried to continue the price upward, but they were unable to, and it closed actually in the negative in that time frame. So this definitely represents that the downtrend is starting and the uptrend is coming to an end. Again, we may come down and test this level, but the reversal is usually very, very strong when we have that type of candle. Bearish engulfing, we went over. Evening star. Okay, so this is another type of doji. This is a bullish doji. So as you can see, price is in an uptrend. Okay, and this candle here is the center of the pattern. So this is the doji, and we see that there was really no movement on this candle, not like we had seen with these candles before, except for that one. Okay, so this represents that we may be coming to a bullish, or sorry, a bearish reversal pattern called the evening star. And what happens after that candle is we normally start to see a reversal pattern. One thing that I'll say on dojis, and this is a little bit more of a this is a little bit more of an advanced concept, but we'll talk about it. When we talk about wicks, wicks represent imbalances in the market. Okay, so if you have a really, really long wick, because one thing that this is not covering is if you have a really, really long wick, that normally represents an imbalance, right? And when I say imbalance, when we talk about trading, we have to know that you have what you call market makers or brokers, right? And these brokers help facilitate your trades. So in any type of trade, in any trading market, in order for there to be buyers, there has to be sellers, right? This is not um, driven by a computer or something. You know what I'm saying? This price action that you're seeing, this story is being told. It's the story of buyers and sellers. Buyers and sellers make this happen. And in order for there to be buyers, there has to be sellers. In order for there to be winners, there has to be losers. You can't buy something without somebody selling it. Okay. So when I say that you have an imbalance, it means that in this period of time, we had a large amount of sellers in this market without there being a whole lot of buyers. And what normally happens with this type of situation is this area will want to be retested. Okay. If it doesn't get immediately retested, sometimes on the next candle, you'll see that you'll have a wick. You'll see that you have price come up and retest the entire imbalance and then wick back down to continue what was supposed to happen in the first place. And that's basically the market maker covering their losses here, right? Or actually, I said that wrong in the beginning. So when you have an imbalance, there's sellers in the market, okay, but the market maker has to place buy orders for those sells to happen, right? Because they have to buy what you're selling, right? So what the market maker or the brokers do, the big fish, is what they'll do is push price up to cover their losses, okay? When they push price up, they're able to close those buys, and then the big selling starts happening. So that's kind of in a nutshell what that means. Um, but the most important thing that I want you to take away is that when you see long wicks, you have imbalances. Back to the dojis. So when we talk about dojis, a doji is simply a candle with an imbalance on both sides. So oftentimes, you'll see when a bearish doji occurs, both ends of that doji have to be retested at some point, right? With one of them being the dominant side. In this case, it's the bearish side. Um, but the top of that doji may be retested before this price action happens, and that's oftentimes what happens. You'll see price come up and test the top, and then we will fall. So always bear in mind when you see a doji, sometimes uh, the best time to start looking for price to reverse is when this other side has already been retested. Okay, unless we just outright start to fall and get below, my entry point would probably be below this level here. Okay, I'm gonna leave that. So, three black crows. So okay, don't really use this one too often. It says the three black crows candlestick pattern comprises of three consecutive long red candles with short or non-existent wicks. Each session opens at a similar price to the previous day, but selling pressures push the price lower and lower with each close. Traders interpret this pattern as the start of a bearish downtrend, as the sellers have overtaken the buyers 3 consecutive trading days. All right. So the way I would look at this, and this is we're getting closer and closer to supports and resistances. I mean, just what I'm looking at. So we had a strong uptrend. I see that we had a little bit of consolidation in this level. So that's a level that I'm looking at. Once we break below this level, once this pattern breaks below this level, we are clear to get in a sell. And you can see that price came up and it retested this level and continued on the way down. That's the way that I would take that pattern. Again, you kind of have to understand support and resistance to understand that, but we'll talk about that here in a minute. Dark cloud covered. I'm not even. Yeah, this one. I mean, I could. It says the dark cloud cover candlestick pattern indicates a bearish reversal, a black cloud over the previous day's optimism. It comprises two candlesticks, a red candlestick with a red candlestick which price opens above the previous green body and closes below its midpoint. So again, talking about that 50% level, it signals that the bears have taken over the session, pushing the price sharply lower. If the wicks of the candles are short, it suggests that the downtrend was extremely decisive. So for this is kind of going to put together. Yeah, this was a good one to go over. This one's kind of going to put together what we talked about with the structure of the candle. So again, you have your opening price, you have your closing price, you have your high of the day, you have your low of the day. Okay, so That covers the candle structure. And what they're saying is this candle here, it opened above the other one, but look at where it closed. It closed below the midpoint of the previous day, below the midpoint of the previous day, right here, whereabouts. The next day is the confirmation, right? And that's exactly what I was talking about. So the next day actually comes up and rejects the 50% level. So we are very likely to continue downward here. Why? We already have the strong bullish or strong bearish sentiment in this candle here. And we already have the 50% level showing confirmation that we're going to come down. We are very highly likely to come down. One thing that might happen is we might retest this level, but if we were to come back and retest this level, I would be likely to start buying. If we reject here, my strongest setup would be a sell. And then we have, let's see, for continuation, candlestick patterns. Yep. So we talk a little bit about dojis and how they can represent a continuation. Sometimes they don't end up they don't end up being a hold on. They don't end up being a reversal. They end up being a continuation. So in this case, we had the hammer right here, which is a bullish pattern. Uh, the bulls failed to move price significantly up with that reversal pattern or with that pattern. Um, the next candle here shows us that now it's basically it's a story, right? So the bulls had their turn. They didn't do what they were supposed to do. Now let's see what happened on the next candle. On the next candle, the bears got their turn. They didn't do what they were supposed to do. So there's no decision in these two candles. But the previous candle still stands, right? That means that there is no decision after this candle. We don't know whether we want to go up or down yet, but we still have this candle here. So this candle still stands. So what's going to happen next is the low of that candle is going to be tested, likely, and then we're going to start to push up. Okay, going to try to push up, and you can see that happens in that wick right there, and maybe going forward, we push up on the next candle afterward. Spinning top. So spinning top is pretty much the same thing as what we were talking about here. So no decision here. So let's see what it says. So a spinning top candlestick pattern has a short body centered between wicks of equal length. The pattern indicates strong indecision in the market, resulting in no meaningful change in price. The bulls sent the price higher while the bears pushed it low again. See, so spinning tops are often interpreted as a period of consolidation or rest following a significant uptrend. So we'll talk about consolidation a little bit later also. Um, on its own, the spinning top is a relatively benign signal, but they can be interpreted as a sign of things to come as it signifies that the current market pressure is losing control. So if this was a bullish candle before this candle, the bulls failed to do their job, the bears failed to do their job. There's no real movement, but the statement still stands, right? If this was a bearish candle before this one, a bearish engulfing, there's no real movement, but that statement still stands and we're likely to continue down. That's the way that I would interpret that. This is one of my favorite patterns. This is the falling three, and then you have the rising three. Okay, so this happens after a strong bull or bearish candle, and then you'll have these three candles, right? And these three candles, well, all three of them fail to retest the top of that candle or break above. So if you have one candle that breaks above the 50% level, that's different. But if it took three candles just to get barely to the top, then we're likely to continue down. That's basically what that means. On the opposite side, we have the rising three, and the rising three would basically be the opposite. So you have the bullish engulfing candle, and it looks like the bears tried for 3 days. It took them 3 days to get here. We're not going down. We're about to blast off. That was the correction. That's all it is. It represents a correction. I use this one a whole lot. So what I'm gonna do is I'm gonna keep this open, and at the end of the video, I'll send this link. This is a pretty good article. I like this one. It helped me get through the candlestick patterns for you guys. Um, there's more candlesticks to learn than this, but this is a really good start. I feel like this is a really good start. So without with all that being said, let's get back to trading view and let's take what we know to the charts and let's talk about support and resistance levels real quick. And if you feel like you got to take a break, if you feel like you got to take a break, feel free to pause and go take a break for a second. Uh, oh, there we go. All right. All right. Okay. So now back to trading view. So looking at US 30 again, uh, we happen to be on the monthly time frame. I've explained the time frames, different types of time frames that you can get into, and that every one of these candles represents a period of time. So let's go ahead and talk about supports and resistance levels. So this is actually a pretty good day to talk about it. Yeah, let's get right into it. So when we talk about support levels, we talk about what you call price floors. When we talk about resistance levels, we talk about price ceilings. So in the scope of the entire market, okay, we have levels of price that were respected and were eventually broken and retested, and new levels of price were made. So when we want to say support, or when we want to say resistance levels, we have to look at prices or times where price was coming up and it respected a level. And when we talk about price floors or supports, we want to look where price was coming down and it respected a level. So let's look at, or actually, I'm just going to go ahead and so I can get as I want to get as focused as I can. Let's look at the daily. Okay, let's look at some really strong support and resistance levels on a daily. So let's just start here. If we want to identify supports and resistance levels, we have to look to our left, right? And a lot of times in the chat, you'll hear me say, look left, just look left, right? If you look, if you're here, let's just pretend none of this exists yet. Okay, you are here. If you look to your left, you want to know what price levels are important to look at. What I am looking at is where price reversed at. Okay, on the current trend down here, where did price show me reversals at or show me consolidation at? So if we look just immediately looking to the left, what I see is that price reversed here, price reversed here, price was on a downtrend here, came up, reversed here, and price was on an uptrend here and reversed here. So these are all strong levels in the market, right? With this level being very strong. So when price got here, something about 39.5 or 35,693 was really special, right? And if you keep looking left, you're gonna find out why. Right? Eventually you're gonna find out why. But something about this price level was really important. So we rejected here, and that was the start of a downtrend. Okay. Eventually, it looks like we came to another reversal here. That was a reversal right here, and then we reversed here. So these levels all show significant levels of price action. And what I'm talking about when I say price action is I'm looking for reactions. I'm looking for price to do something at a specific level to show me what is going on at that point in time. So, and that's our low right there. This is another level here that was important right here. This level was another reversal pattern, another reversal spot. So now going forward, having these price levels in mind, we can see what happened, right? So here's the engulfing, right? The engulfing tells me that price is likely to come up. Price came up, okay? Looks like we tapped into this level here. The rejection that could have happened at this level was not, it never happened. So price was going to go on to the next most important level, right? Which was here. And look what happened. Price came up to this level and started to reject, right? It gave us the consolidation. Price came up, back above. Looks like a brief retest might have happened on that doji and continued up to the next level, right? So we're playing moves that happened in the past. It's all about playing moves that happened in the past. So if I'm getting in here, if I'm looking here, my next level to look at would be this level, right? Well, price came up, it hit that level, and it broke it with strong force, right? The correction actually happened a little bit afterward. There's our three methods, our three method pattern that we just looked at that, right? And then the reversal happened. So these levels in the past are all important. Okay. Think about it this way. If if you got a car that you're trying to buy, right? And let's say at one point the car costs $10,000, right? But you can't afford it at $10,000. You want to buy it for for like $5,000. Well, price comes down, or or let's just say let's not talk about what you can afford. Let's just say the car costs $10,000. Okay, but you're just looking at buying the car, right? Price comes down to 5,000, you still don't buy. Okay, price goes up to 20,000. Now you're like, shit, I fucking missed out. I definitely can't buy this shit. If price comes back down to 10,000 and stays there for a good amount of time, you should probably buy. It's probably not going to go any lower than that. That's kind of that's like maybe not the best example, but that's kind of what's going on here, right? When you see certain price levels hit and rejected off of, it tells a story. When price breaks above with force, it tells a story. So you're looking for specific price levels where shit happened, right? Where stuff happened. And when you want to find support levels and resistance levels, the main thing that I would like you to do is just look left. Now, when we talk about time frames, this is the daily time frame. So on the daily time frame, you're going to have very strong levels of support and resistance, right? The same levels that you will find on the daily time frame can be located on the 5, 15 minute, the 1 hour as well. And they're very strong levels. Now, you can also locate levels of support and resistance on, say, the 5 minute or the 1 minute, but those levels are a lot likely to be broken than the daily levels, right? Because remember, like I said, when you look at higher levels or higher time frames, you're looking at a lot more data. You're seeing a lot more of the market at one time. So let's say we went to say the weekly. If we went to the weekly, I can identify immediately going from here. I can tell you immediately what the support levels and resistances are. If I was looking from right here, if I'm looking from right here, my immediate resistance level or level of interest would have been here. I also have a strong period of consolidation that happened here. That would have been a resistance level here. And then this would have been the biggest one right here. Well, it looks like price came down and started a huge downtrend. And what happens at this level is we broke this level with force. So now we're looking for the next level. We broke this level with force. Now we're looking for the next level. We broke this level with force. And now we're in a complete bull market at that time, right? But if this downtrend that we're looking at now continues, theoretically, if we do not bounce, say around this level, we haven't bounced here. We could bounce here, right? This week is not done yet. We could bounce here. If we don't bounce here, then I'm gonna have to assume we start testing this level, and eventually this level, right? Can that happen? Yes. Is it likely? Maybe, right? Because this uptrend right here has been very strong. But this also tells me that price is it's about due for a correction at the same time. So we can talk about that another time because we're just talking about support and resistance and how to identify. But that's what I'm seeing on the weekly time frame. But the point that I'm trying to make is that these levels are very, very strong on the weekly time frame or on the higher time frames. Now, if we go to the 5 minute, you can identify the same levels, right? The same exact levels will show up on the 5 minute. So if we go, let's go to like say the daily, and let's mark out some key levels on the daily. Let's see what we find on the daily. Ooh, shit. All right. So let's look say from right here, right? So shit. All right. So if we look from right here, that's a key level, that's a key level, that's a key level. Okay. I'm just gonna mark everything up. Fuck it. That's a key level right there. Okay. So those are key levels. If we started right here, you would see this is a key level, this is a key level, right? And if you want to start from the present, I can tell you that that's a key level. That this is a resistance level, right? That's a resistance level. That's a resistance level up here. So they all jive the same way. So if we go back down to the 5, those same levels, look at where my lines are. I didn't move nothing. I didn't move shit. Is it spot on with right there? No, but I could have easily moved it there. It's close, right? You can see the reaction at the same spot right here. So the advantage to looking at the lower time frames is that you get a more precise picture, right, of what's going on. So you can see the levels a little bit better on the higher time frames. They're much more stronger on the higher time frames. On the lower time frames, you get like a really precise picture of what's going on. You can see here the same levels are at nearly the same spots, right? It's not completely spot on, but something is happening at that level, right? It's not always right at the line. It doesn't have to be right at the line. It's more so in the area of that price. In that area, price happened. Okay. Price came up, and in that area, it retested and broke up. It came back down right here. I believe this was an NFP day. Price broke that area with force. It broke that area with force. And once we got below this area, we had to come down to this level here. Well, we didn't have to because really, well, yeah, if we look to our left, that was a target right there. So it's all about looking left. If I want to find a target, I'm just literally looking to my left. The price came here, and not too long after, it respected that level, tried to come down, and it came back to this level here. So what does it do? It comes back up and respects this level. Always look to your left. Just look left. Price respected, and we stayed in this range right here for some time. We consolidated, okay? Then the news came in, and we dropped again. That was today. Or actually, no. I don't think we had news on Tuesday, but we still ended up dropping right here. The news happened on this candle. Sorry. So we broke and we retested again, and we came up to this level, and we still are not able to break that resistance level. Okay. What does that tell us? That we're about to sell the shit out of US 30. And that's exactly what happened. News had a lot to do with it, but the concept still stands. We sold, and what did I say this morning? What I said this morning, if anybody was looking, I called it out on MetaTrader. I didn't call an official signal, but I called it out on MetaTrader. And what I said was that I immediately looked at this level and I looked at this level. right here. And what I said was that we can either come up and retest that level, we can come up to this level and retest that level, or if we break above this level, we might come back up here, in which I would be looking at that level, right? I didn't say it explicitly, but I gave you the drawing, the three possibilities. I always give you three possibilities, right? What did we do today? We came up immediately after, retested the level, and we have not been able to get above that level. So right now, we may be looking for sells on US 30. We might be looking for sells on US 30. If you look at this from the daily perspective, though, we're also near a daily support level, but we have broken it. So what we're looking now is we're looking for the retest and the downtrend. Okay. There's also support right here. If we did tap it slightly, if we bounce, if this candle gives me bullish sentiment, we could attack this level. If we get above this level, we could attack this level. And then I would like to talk a little bit about market structure, but that's for another video. So that's kind of in a nutshell horizontal support and resistance levels. Um, and I think that gives you what you need. If you need to take a break at this time, just feel free to pause and do that. I'm gonna continue on with the video. All right, now let's talk about a little bit more advanced concepts with support and resistance. I'm gonna go ahead and talk about trend line supports, trend line resistances. Yeah, we have a really good example. So when I say a trend line, I literally mean just that. So this is a trend line. Okay. Now you have different. The thing that I don't like about trend lines, I like trend lines, but you got to be careful with them. Trend lines are very subjective, right? You do this, you do this, right? In general, the best angle for a trend line is say around 30 to 45 degrees. And I think I should have a tool on here. So in this case, this one's about 39 degrees. So that's a good trend line. And then also what you will want to look for is 3 taps to confirm that trend line. In this case, we have the start, we have a near tap. It doesn't have to be perfect, right? But it's definitely there. Okay. And then you have the third tap right there. So this is indicating that we are currently in a very confirmed and strong downtrend in the market right now for US 30. That's your trend line. A case of a bullish trend line, that's a bearish trend line. In the case of a bullish trend line, I mean, you clearly see we're on an uptrend here, right? And the trend line, it does not have to be perfect, right? Because I mean, I have one right here. That's one. Shit, that's a trend line right there. We had some consolidation. You see that we broke below the trend line. We had a little bit of consolidation, and then we started a new trend line. That's a level right there. Broke below. Looks like we retested, but we consolidated. We came back up. Not able to break over that trend again and start a really strong uptrend. So really, we could have been looking at selling here, but we got consolidation. No real, no real trend line here, but we did make a higher high, and we retested that high, and now we have started a downtrend. So that's basically what trend lines represent. Trend lines are important because you can also look at them on, say, the 5 minute, and this goes back to what I was saying about zooming into the lower time frames. That same exact trend line is there on the 5 minute, only in a lot more detail. Same exact trend line. So those are trend lines. And one thing that I'll say is that you can have a trend within a trend, right? So if we look at the daily, right, we are clearly we were clearly in an uptrend during this time frame, right? But you have these little points here where we're in a downtrend, in a correction, right? Like here, here. This one's a little bit less. Well, this was based on the 1 hour. So move it here. I wouldn't really consider that a trend line right there. It's a little bit that angle's a little bit too obscure, but we see that we were in an uptrend. But every one of these little downtrends in here, you're probably going to be able to locate smaller trend lines because again, you have trends within trends. So trend lines can be the point that I'm trying to make with that is that trend lines can be drawn on any time frame, any type of way you want to trade. You can draw trend lines and you can find support levels and resistances and trade off them. All right, now let's talk about. I'm going to talk about order block identification. So this one is very, very powerful. Clean up a little bit. So when we talk about order blocks, we're mainly talking about reversal patterns in the market, and these blocks mark out reversal patterns, and they mark out key levels of support and resistance. Where if price comes back to that level, it's likely to reverse back up to a different direction and respect that level. And if it breaks below that level, it could be the starting point of a new trend. So let's say we look at the 1 hour. It's probably be the best time frame to look right now. And let's identify order blocks. So an order block, you have a bullish order block and you have bearish order blocks. Okay. Bullish order blocks. Well, let's start out with bearish order blocks because that's what we're looking at right now. When you have a bearish order block, it represents a candle. It's the last candle before the strong downtrend started, right? So in this case, what I see is that the first bearish order block occurred here, and the order block is going to be made of the entire candle. Okay, that's the order block. Okay, so this is a zone of price, and this, in my opinion, is almost it's stronger than a standard support or standard resistance because it's not a specific level, it's an area. And that's really what I rely on is the fact that it's an area. It does not have to come price does not have to come to that exact price level where price rejected that high right there. It doesn't have to get right up there. It just has to get up to the area. It just has to get close. That's it. So we come down and we see that the next order block, right? We came down, we consolidated. This would be considered a small order block right here. Okay. It was a bullish candle, and then we had a strong downtrend afterward. That's considered a level right there. Okay. Came down right here. That would be considered a level right there. So we got all these levels. And it's not that candle, it's the candle right after. It's that one. You see that price rejected right there, right? Came down here, and this would be the last bullish. Okay, price came up right here. This is more consolidation. And then we have this most recent order block, which is that level right there, which is where price might come up now before we start selling again if we do break back above that support level. Yeah, order blocks are strong. Order blocks are very, very strong areas to look at. So when we talk about context, what I'm looking for now is, like I said, we had this level of support right here. If we break above this level and retest, I would be looking for a potential to run up here or get at least close to get to this level and then start selling again. Those are bearish order blocks. Now let's talk a little bit about bullish order blocks. So if we look at bullish order blocks, let's look at an uptrend here. This looks a little bit more consolidation like. I still could, let me see. Got a little period right here. Yeah, we had a pretty good run right there. So let's look right here for some bullish ones. So we'll start here. This is the first one that I see right there. That, and I'm just curious to see where that ends up over here. Okay. So that's the bullish. That's a bullish order block, right? Come in the feet, or we come now to the next level. Looks like we consolidate a little bit. That's the next bullish order block, and the bullish order block is going to be the last red candle before a strong uptrend. All right, so that's the next level here, and you can see what happens on the next level, or in the future. I mean, when price came back down and it hit that level, look what happened. We rejected, right? It was very strong to break that level, or very hard to break that level. So we came back up and we rejected, and then we sold again, right? So these are levels to just pay attention to. Does not always happen, but you want to give it some respect. Okay. The next level happens here. So again, we're looking for the last red candle before the downtrend. Boom, right there. Another bullish order block. So we come up and look what happens. When we come back down, we came into that zone, we consolidated, and this is the starting point for a sell, right? So we came down, we broke below, right? Just because we didn't close below doesn't mean that it's not going to sell. The bears still pushed price low, right? It still was pushed below the zone, so it's still a potential to sell later. This level here tries to pick up off of the wick. This candle here tries to pick up off of that wick. That's a failed push. We get the next push down, we break below. Now I'm selling. So we sell there. Even when we came back up here, we rejected this level again. So this is an area to watch. We broke above, and now we're solidly above. On the next candle, we drop down and consolidate a little bit, but it looks like it's safe to buy at least until this level right here. We buy, we hit that target, and we break above slightly more, and then we start consolidating again. We get the drop. So you have to get the drop first. You can't just predict that it's going to drop. You have to get the drop first, right? Let it confirm itself. It drops, and now we're in the start of a downtrend. We get another order block here that forms. We consolidate underneath the order block, and we're clear to either sell again, or you could wait for the retest. Me personally, I probably would have missed that move because I like to wait for the retest. But a sell happens, we come back down to this level, we reject on here, and we come up and we get a better opportunity, and we actually do get a break and retest, or sorry, we get a retest on this level here. So that's more of what I was looking for. It's more my speed. We reject here. At this point, I'm probably going to start selling. We sell, and now the new order block is formed. This is a level that's yet to be tested. We consolidate here. This is pretty good range right here. And now we have a new order block that's formed. So what we're looking at is we could either stay under this level, but if we come above this level, then I'm going to be looking for this order block to be tested. But for now, it looks like we're going to stay above or stay under that level. So those are order blocks. And order blocks, in my opinion, again, are like I said, they're very, very powerful. They represent institutional activity. And when I say institutional activity, I mean the big dogs, the folks that actually have the money to make the market move the way that it does, the way that it does. So I think that's about it for that. The next thing that I want to cover before we end, and this is going to kind of bring it all together, is the concept of the break and the retest. So the break and the retest. And let me clean some of this up. The break and retest is going to be how you put all this together in your daily trading. So for that, I'm gonna go. Let's say that we go down to the 15 minute, and let's try to mark out. Let's try to mark out some levels real quick. Talk about, or actually, you know what? So that way we can get a more clear overview. You can look at it on the 15 minute. I'm gonna let you practice on the 15 minute. For me though, since I'm getting a little bit tired, I'm gonna practice on the daily so I can kind of shorten this up a little bit. So let's mark out those same levels that we marked out before. I think those were them, and I think we had this one also. All right. So when we want to talk about breaking and retesting, right? Not every one of these levels is a good example, but when we want to talk about breaking and retesting, it basically means exactly that. So price made a low here, and we continued up towards this level, and you can see that what happened was we broke above, and a lot of traders will make the mistake of entering in immediately after we break above, right, to take on that uptrend. But what will actually happen is price will come down and retest this level or this area and give us a better opportunity, right? So price breaks and it retests. Once you see the retest, what I'm looking for is the confirmation that this level is still a level that's okay to buy at. So in this case, it actually looks like you have two retests. What happened was price broke above. This doji or this candle was actually the retest, and this candle was the confirmation to get in. So you could have gotten in. You could have gotten in on this candle, or you could have gotten in on the close of that candle. That's probably the better opportunity would be the close. So really, yeah, you could have gotten in on the close of this candle or the open of this candle right here. That's an entry. Your second retest occurs with these two candles, where you retest, price did break below the level again. So you have to wait now for price to break back above and close. When price breaks back above and close, it represents the formation of a second retest. When price retests the second time, now you definitely can get in. So you have two entries. You have one here and one here. Okay. Um, that's basically it. That's basically it. So once we talk about breaking and retesting, you can see it happened again, right? Break price broke above and it continued up a little bit more, but it did come back and retest that level. Once it retests this level, okay, you probably can go ahead and enter in on the close of that next candle and continue the uptrend right there. And if I look to the left, I'll probably find a level that coincides with all of these consolidation points or all of these correction points. So that's basically it when it comes to breaking and retesting. So you can break and retest on a horizontal support or resistance. You can break and retest a trend line support and resistance. You can break and retest a moving average, which is something that I'll talk about later. That's a dynamic support and resistance. Um, the break and retest concept is very universal. You can break and retest an order block. Um, so you always want to make sure you wait for the retest. Look at it like you're looking both ways before you cross the street. That's basically what it is. I mean, you're free to get in, when you break. But if you get in on the break, you're leaving yourself open to the potential for that to be a failed breakout, what you call a false breakout. So always try to wait for the retest. Okay. Another thing that I'll say about support and resistance levels, and I'll leave off with this because it's very important, is that support and resistance levels will often mark your price targets and your price stop losses. So let's say that I took this setup right here. We broke above, we retested, and I took this setup right here. So in this case, I have two setups that I could have took. I have the setup that I got in on the open of this candle, and I have the setup that I got in on the close of this candle. Right, that represents the first break and retest, the second break and retest. Right. So my first setup, I would have gotten in right here at this level, and you want to ask yourself, where is a good level to have your TP at or your take profit level at? Well, your take profit level is going to be placed up at the next resistance level, right? That's a strong level of resistance. So it marks a strong reversal point. All of my take profit levels are always reversal points. Now you want to ask yourself, where's a good place to put your stop loss at? And in my honest opinion, it did not work out this time, right? But my stop loss level, if I seen this retest, right, and I wanted to get in on the open of that candle, my stop loss would have likely been below the low of the preceding candle, right? In this case, it didn't work out, and not all trades will work out. So we did get stopped out here. But if we look at the second setup, uh, we retested the area again, and we got confirmation here. Since we actually broke down below the level, I have to wait for this candle to close to make sure that this is not just a retest of this level. Once it closes and confirms that we're good to go, I get in on the close of that candle, or I can get in on the open of the preceding or the next candle, right? My stop loss would be right here. So where's my TP and what does this setup look like? So if we look, I'm gonna say long position. This setup looks just like this right there. So my position is getting in. Actually, it's gonna be at the start of that candle. So at the start of this candle, I got in. My stop loss would have to be at least below this level. If you'd like, you can put it below the 50% level, or maybe below these levels here, right? Those are significant levels. That is the level of resistance that we were previously at. Now it's a floor. So when we talk about the break and retest, if you break a resistance level and you retest it, it is now a price floor. It's converted to a price floor. If you break a support level and you retest it, it's now a floor resistance level. Okay. That converts it to a resistance level. So again, when I'm looking at resistance levels and support levels, they help me determine uh, where my stop losses and take profits are. More so, it's based on for stop losses, it's more so based on the candle. Like I said, when I wanted to put stop loss below that entire candle, that's where I would normally have my stop. But on the TPs, or the take profits, it's really based on the next key level of resistance or support. So I'm gonna go ahead and close out. Next time, let's see what we got to cover next time, real quick. Uh, go back just real quick. All right. So on the next one, what we're gonna talk about is we're gonna talk about market structure, and we're gonna get into our higher lows, our higher highs, lower lows, and lower highs, and then we're also gonna talk about consolidation, which is what we covered today. So, and then we'll also talk about market structures and meetings. So, your head and shoulders, your bearish flags, your bearish pennants, bullish flags, bullish pennants, things like that. So, We'll talk about that, and I'm really looking forward to it. So I'm sorry this video was so lengthy, but I really hope that you got what you needed to get out of it. And man, I'll see y'all next time. Appreciate y'all tapping in.